So it's about an hour and 15-minute drive from where I am sitting currently to Apple headquarters here in Northern California. And in the headquarters right now over at Apple, they're saying, China, we have a problem. What is going on, investors? Hopefully, guys are doing well out there. Time to look at the big boy stock of them all. That is Apple Computer, ticker symbol AAPL. You know all that. And look, you know, over the last year, shares have done okay. Not really outperformed a whole lot. Up just, and I say just, 14%. Year to date, though, they've been in rally mode. Up 16.5%. The company announced their Q3 earnings after the bell, and they're clean, right? Whenever we get Apple earnings, they're super clean. They're super easy to understand. So if you're new to investing, new to looking at the financials, Apple actually, even being one of the largest companies, is actually one of the easiest to understand. So you're going to learn some stuff there. But we've got a problem over at Apple. And if they don't solve it, I tell you what, shares likely to come under pressure. Now, speaking of under pressure, in the after hours, initially you had a small bump in shares of Apple. I was reading through the financial reports and I was like, I don't think there's anything in here to get wildly excited about. And that's more or less the consensus we're seeing in shares in the after hours, down about 1.7% during the regular trade, down another 2% as we speak in the after hours. There's not a lot that they can say usually on the conference call. It's not like a Tesla or a Microsoft or some of these other companies. It's going to be tough for Apple to turn things around in the after hours. We're seeing a peak to current price action in Apple down 10%. I'm going to tell you where I think a lot of these mega cap stocks are heading. Hint that we're probably heading even lower. Now, we talked about year to date. You're up pretty good on Apple. So a little bit of correction in the shares, not going to really hurt anybody. Now, revenue actually came in over what certainly expectations were on Wall Street, but way over and above probably what I was expecting. Revenue came in at $85.8 billion. That was roughly 5% growth year over year. Beat expectations by about $1.42 billion. The expectations had been reined in a little bit. I looked at Wall Street estimates, and just understand that the estimate is based on the current estimate. Over the quarter, and certainly over the year, you have a reining in of expectations. And with Apple, they reined them in just a little bit. So they beat expectations, which had the bar more or less lowered. High-end estimate was for $88.9 billion, so they're way underneath that. The low end was for $82.8, so they're coming in solidly above that. Now, I don't think it brings into question anything that Apple has going forward. Probably a 4% quarter next. We're going to do about $93 billion worth of revenue. I believe typically you have towards the last few weeks of that quarter is the release of the new iPhone. And then finally you have what they call their fiscal Q1, which is typically a fourth quarter from a calendar perspective. That's also a holiday shopping season where they have full-blown iPhone sales. You also have maybe potentially some new MacBooks, maybe some other new products. $126 billion. That would be about 4 to 6% growth for the next 2 quarters. I don't think anybody's questioning that. I don't even think we're questioning going out several quarters with Apple growing at 6-7%, getting north of $100 billion in more than just the fourth quarter. I don't think any of that comes under question. So what's the problem? What's the problem, and why do we have a problem over at Apple? Well, let's take a look at things. Total net sales we talked about came in at that $85.8 billion. Last year, you were closer to, we'll call that $81.8 billion. Over the last year, your product sales really didn't move a whole lot. From $60.6 billion, again, this is your iPhone, your iMacs, all those types of things, $61.6 billion. So just a little bit of an increase. I mean, that's $1 billion. But it's not a dramatic increase when we're talking about $85 billion worth of sales. What really got pumped up over the last year is your services from $21 billion up to $24 billion. So they're doing a great job monetizing their devices, continuing to squeeze out more from a monthly fee. I tell you what, every couple of weeks I get a charge from Apple, $1.99 or $34.99, and I'm like, what the hell is that for? But you figure you just might as well keep paying it. From a gross margin perspective, off of this $85.8 billion, we had about $46 billion in cost. So our gross profit, they list it here as gross margin. This is typically listed as gross profit. $39.7 billion last year, you were at $36.4 billion. Now, what we saw when we looked at Meta, we just looked at Amazon, we've looked at Microsoft, they've cut cost in their selling general administrative They all continue to reinvest in research and development. That's certainly what we've seen over at Apple, from $7.4 billion up to $8 billion. But what this company hasn't cut is their SG&A line. Look at this. From, we'll call that $6 billion up to $6.3 billion. We're actually seeing most companies being able to draw down cost in their SG&A line. Apple not able to do that. Here's your total operating expenses from $13.4 billion up to $14.4 billion. So you take this $39.7 minus off $14.4 or $14.3 billion of expenses, and you get operating income coming in at $25.4 billion. Last year, you were closer to, we'll call that $23 billion. For the last 9 months, first half of the year or so, and into last year, you had $93.6 billion of operating income. That's not revenue. That is straight operating income. You pull down to a net income after you pay taxes. It's close to $80 billion in the quarter. It was 21.5, incrementally better, but like 10% better across the board, as the company is not really driving down their operating expenses as much as we're seeing other companies. But that's not the problem. Here's your segment in terms of geographic regions. Over in America, look, you had decent growth from a revenue perspective from 35 up to 37. In Europe, you experienced some growth from 20 up to, we'll call that 22. In Japan, you had pretty nice growth from 4.8 up to, we'll call that 5.1. And rest of APAC, you went from 5.6, solid growth there, man. They really penetrated rest of Asia Pacific. Probably some India growth there. $6.4 billion up from 5.6. But here's your problem. Here's a big problem. Is your Greater China revenue. Look at this, from 15.8 down to 14.7. Is this a China problem? Is this the China economy? Tell you what, if it's just the China economy, well, you're going to have massive fiscal stimulus coming from the government over in China, and you might have a reacceleration of these numbers. That's particularly bullish probably for Apple, probably bullish for companies like Nike, Starbucks, anybody that has a big presence or a big chunk of their business in China. But if this is a brand thing, and we're seeing lots of press releases, look, we recap all the press releases from Apple every single week, Friday on the show. If you're not subscribed, if you're not liking the videos, I don't know what you're doing. Also down below, you can follow me on Twitter, follow me on Instagram, LinkedIn, all those places. Love to see you over there. But we keep track of everything that Apple is doing. And we're seeing other brands start to outsell them in China. Domestic brands start to outsell them. We're seeing some blowback from the Chinese government in terms of using iPhones. And certainly, well, look, $14.8 billion in sales is still absolutely great. But when every other region had growth except for China, it makes me wonder, is this just a one-off thing, or is this something that can reaccelerate? If this can reaccelerate, well, you are buying the dip at some point on Apple, because this number could reaccelerate. Now, in terms of categories, iPhone basically down a little bit. You'd expect that moving into a refresh cycle. Mac ticking up a little bit. iPads, they finally released, I think, a refresh of the iPad, and you see a massive acceleration here from 5.8 up to 7.1. Wearables and home accessories haven't had a refresh more recently, so those tick down from 8.2 down to about $8.1 billion. Potentially a new iWatch coming, I think, later this year, could potentially reaccelerate there. But I tell you what, we've got a China problem. China, we have a problem over at Apple if this number doesn't reaccelerate. And we saw the same thing over at Nike. We're seeing a similar thing at Starbucks and those types of companies, is if domestically they're not able to reaccelerate and domestic competitors are chewing into that business and that business is not coming back, well, that's a problem. If it's just a Chinese economy thing, don't worry. They'll make it rain in China just like they do here in the United States, and eventually that number will recover. Speaking of recovering, you ain't worried about Apple. This is why when the shares dip, you get excited, because they have plenty of cash to weather the storm. They have another kind of marketable security line. This is the only company I ever see do this, where they have cash equivalents, they have marketable securities, but they have this second line item for marketable securities. I'm not sure why they have to put it under non-current assets. If you have your CPA degree, you probably know why, but yeah, it's just weird that they don't have their full cash balance up here on the top two lines. They actually have more of it down here. Now, from a debt perspective, some of that debt, some of that paper is coming due. You got about $12 billion due over the next 12 months, but we've seen over the past year, they're ticking this down a little bit. from 95 billion. I mean, this is a lot of debt, 95 to 86. But if you look at the interest rate that they're borrowing this debt at, I mean, if you have a 3% mortgage, their interest rate on this term debt, I actually think is lower in most cases. So they're basically paying nothing on that term debt. So nothing to be overly concerned about. Now they give us a 9-month cash flow here. Net income coming in at that $79 billion. Operating cash flows through 9 months. I mean, look, outside of an iPhone release and a sluggish China, although I think the last 9 months does include the fourth quarter, so it does include an iPhone release, you're doing about $30 billion a quarter in terms of operating cash flow, at least on a run rate perspective. That's slightly higher than you were a year ago. So you take this $90 billion, you don't really have to do a lot of purchase of property, plant, and equipment. They did. This is interesting. So you're seeing Google, Microsoft. We just did Amazon. I think they did $17 billion of property, plant, and equipment in a quarter. Look at this. Over the last year with Apple, you went from 8.8 down to 6.5. So you're actually driving down the cost in terms of property, plant, and equipment. Be interesting to see if that reaccelerates into the back half of the year. But it's nothing compared to the $90 billion. So what do they do with all that? Well, they're buying back the stock. So there's always going to be kind of this call option underneath the shares of Apple. They're paying dividends as well, and they continue to repay the debt as well. Things are looking good for Apple. Now speaking of looking good, I'm seeing in the after hours, we've actually kind of gotten back to even. So that's interesting with Apple. Certainly wouldn't have expected that based on the numbers and based on what I'm seeing here. But peak to trough, you're down about 8% from the peaks that you've made in shares of Apple. And until you really kind of meaningfully get back over these highs that you made really just about a month ago, so you'd have to come back here into the 240s, maybe even as high as 250 to really confirm that this trend, you'd have to assume that maybe at least the shorter term momentum in this stock should continue to go sideways. I'm not convinced that you don't come down here, maybe not a full back test of the previous highs that we made back in December and earlier this year, and certainly back in 2023. Back here at about 200, I think somewhere south of, maybe we'll call it about 210 on this one, could be your first buying opportunity. There's some area right here at about 207 that probably should create some support. I don't think these numbers make me want to run out and go and buy Apple and maybe go overweight. Certainly the performance of the stock, not only year to date, but over the past year, doesn't make me believe that this stock is going to do anything spectacular over the 12 months. But obviously, from a safety perspective, they're buying back tons of the stock. You're going to get a small dividend payment. You'll probably see an increasement of that over the next couple of months as well. Company's not going to completely fall on its face, so parking your money in Apple, certainly wouldn't blame anybody for doing that. And we're seeing a reversal in the after hours, at least at the current time, up fractionally after the company reported their Q3 earnings. Folks, that was Apple's Q3. Oh my God, I got to do an Intel video here pretty soon. Stay tuned for that one, and good luck with your investments.